Inflation ran higher than expected in June, the message it is sending to the stock market in this week's fastest 4 minutes in finance. Hello again, I'm Scott Inman. Well, as we record this segment, the inflation data for June is still being digested, but the numbers are again staggering. The Consumer Price Index, which features the largest basket of consumer goods and services, increased 9.1% year over year. That's the highest level since 1981 and higher than the estimated 8.8% from experts. The big jump was driven largely by gas, which was up almost 60% since last June. The prices of meat, poultry, fish, and eggs were up 11.7% in the past year. Now, excluding gas and groceries, core CPI was up 5.9%. The stock market responded initially by retreating more than 1%, but as the numbers were digested, investors seem to be finding some silver linings as the markets have pulled back up off their lows. So let's take the food and gas category. The prices of meat, poultry, fish, and eggs actually dropped 0.4% compared to the prior month. And we know gas prices are already going down in July, down 4.7% from the June peak. Excluding those prices, the increase in core CPI was lower in June than it was in May. Now, these may seem like small victories, but they are actually signs that inflation may be peaking. The other takeaway from these inflation numbers is that it will likely keep the Federal Reserve running on the same track they've been running on, which is a path to even higher interest rates. And that is the action they believe can cool demand and create a soft landing for the economy. It's also the action that the stock market wants to see. There is now a 37% chance of the Fed increasing the short-term rate by a full percentage point later this month, according to one FedWatch tool. The bottom line here is we believe we are still sitting at an inflection point in the economy. The markets have searched for and possibly even found the bottom in mid-June and continue to test it. We've seen many trading days over the past couple of weeks in which the major indices started off in the green only to turn red, or started off in the red only to turn green. Investors are not sure which way to go right now. Remember, the market is a forward-looking mechanism, and the forward-looking is very cloudy. Is inflation about to cool off? How much will the Fed raise interest rates? Will it work when they do? Will we enter a recession? If so, how long will it last? These are all questions that won't fully have answers for several months. But if you're investing in the markets for retirement, what matters to you is what will happen over the next decade. Equities are long-term investments. You should not be investing money you need to spend in the next several months in the stock market. A diversified strategy should be part of your financial plan, and your plan should be built to expect times like these. Thanks for listening.